Fantastic.
Barry, good morning. Thanks
Morning,
again
David.
for joining us.
Yes, good to see you.
You too.
I've only got water. I haven't got Guinness, by the way. So, but top of the morning to everybody.
Oh, yes, of course.
St. Paddy's Day. Hey, welcome along, guys. Also, I can confirm I'm not working from home, so there won't be any children charging into the background of the presentation, and I am wearing pants, just in case you're wondering. I hope everything's going well for the start of the year. It's been a bit of a hectic year, industry-wise. But look, we're really excited. I think David and the team have put together a really good subject matter this year, which focuses a little bit more on, I guess, what is it that we do? What is the value of advice for consumers? And you know, how much importance do we actually put on some of the services we provide where, you know, it's not actually the product? So in the next, well, 59 minutes, what we're going to do is run through, firstly, you know, what is actually advice? You know, when we say advice, it means different things to different people. For those of you that follow Good Returns and New Zealand Advice Online, there's a lot of debate about that at the moment with the FAA review, which we're going to discuss at the end of the session. But I thought it's important just to, you know, look back and redefine what is actually advice. And then what are the types of advice models that we see in the marketplace across insurance, mortgage, investments? Generally, they're in product lines. And then looking at what will be successful in the future. And I think the timing on that, as his phone goes off, it's a really good time to be considering this, because as part of the FAA review, would they come up with these new licensing rules, then obviously we're going to have to, as business owners, stop and go, well, okay, what types of services am I going to offer under the new regime? Will they be the traditional ones that I've done, or are there things that I want to be doing differently in the future? So today's a bit of an overview of those different pieces. And then as we go through the next 5, we're going to dive down in deep into each of those areas of how to provide other services, how to work with referral partners, how to look at systems and technology, and how they interact in providing a fantastic value proposition for your clients, which is what we all want to do at the end of the day. So what is financial advice? Well, if we go to the law books, and the Financial Advisors Act 2008, as it stands today, who is a financial advisor? A financial advisor is a person who provides a financial advisor service. And I think this is quite topical at the moment, because with the proposed regime, they're looking to say people can be financial advisors or financial advice representatives. And people seem to get worried that that would include people who sell financial service products as well. Yet just selling a product doesn't always mean you're a financial advisor. So what is a financial advisor service? It's defined in 2 ways. The first one is giving financial advice. So if a person gives a recommendation or an opinion to a client to either buy or hold or sell a financial product, that is financial advice. And you have to be registered to give financial advice on the FSPR, either as a registered financial advisor. And if you want to give financial advice on Category 1 products, obviously you need to be authorised. But there is another definition of a financial advisor service, and that is providing an investment planning service. Now, a planning service is where somebody, an advisor, helps an individual figure out where they are now, where they want to be in the future, and sets up strategies or product, and implements products or recommends implementing products to achieve a plan to meet future outcomes or goals. Now, if we think about the difference between just giving financial advice and a planning service, I think they're really good distinctions. Originally, before the Financial Advisors Act was implemented, the investment planning service was actually called a financial planning service. And I still think there's a place for having that distinction if in the new licensing regime that's being proposed. Because a planning service, you're offering a different proposition. You're not just saying, should I buy this KiwiSaver or not? You're actually saying, well, hang on, before we look at the product, what are your goals for retirement? Let's work that out. Then we can determine what products we need to be able to achieve the goals. And I think it's the same across other areas too. So yes, I can give you financial advice on which mortgage to choose, but hang on, if you've got a plan to buy investment properties and you want to pay the debt off in a certain period of time so that you can achieve financial goals, well, hang on, my recommendation for product, which provider, might actually change if I understand those future objectives. So that's where we're starting to getting into being planners. We're providing a plan, and it can be just in insurance, just in investment, or just in mortgages, but that's a bit different from just offering, should I buy this product or not? So what I'd like you to do is have a bit of a think about what advice do you give and what advice do you say you give? Because sometimes there's a gap, and we've talked about that in the past. Obviously, the IDS golden rule is do what you say you do. Now, when I look at some advisor websites, we might say for insurance advice is, hey, I can give you advice on these products, and there'll be a list of products. Can be the same for investment. They might have managed funds or KiwiSaver. For mortgages, it might say bits and pieces like I can help you select a mortgage. But when I look at a product list like that, it doesn't really tell me what advice you're giving. Is the advice you're giving, well, I'll determine if you want life insurance, I can tell you which products will suit what you want? Or are you asking me, do I need life insurance? Or are you asking me to work out as part of a plan whether I need life insurance and how much? So just saying I give advice on products doesn't really give potentially the full picture to the client of the value of the advice you can provide. So that's where we're talking about product. The other issue is if your proposition is, I sell products and can give you some product advice, the future's looking a bit bleak in that space, and the fact that the competition in that area is about to grow with the implementation of robo-advice, and we're already seeing it with the comparative websites. If your proposition is I can get you the cheapest product or I can help you select the product, well, there are going to be people that can do it faster, cheaper, and easier than a traditional advice model. So what are some of the other ways of describing the advice we do? So, for example, I do personal insurance planning. What we do is we sit down and we go through the 5 main insurable risks, and we design a plan to determine if you actually need insurance or not, what type of insurance is right for your circumstances, and agree on the implementation of any agreed solutions. Now, that as a proposition is not saying I'm going to sell you insurance. That's going to say, well, hang on, let's work out if you need any insurance first of all. So it gets more into a planning service at that point of view. Now, when you start to talk about planning for needs, then we start to get into asking, I guess, a bit deeper questions. So where are you at financially now, and where are you going? What are your plans? Also, you're going to have to start potentially asking about, well, what are your estate plans like? Are trusts involved and things like that, which normally might not come up until later on. You might offer business insurance planning. So once again, hey, we want to provide your business with a plan on how it could ensure the risk of losing key staff member or an owner due to an insurable event. Once again, we need to know a little bit more about the business, and in some cases, businesses haven't thought about that. So you're actually going to start to get into going, well, hang on, we have to have a risk management plan to cover this, because we're obliged to do that as a business, cover our risks, and then determine, well, can we fund that ourselves or do we need insurance? So some of the key advice you give isn't about the insurance product, it's actually about putting in place a business continuation plan, not just business insurance. But also, we can say to clients, yep, I can do a business insurance plan or a personal insurance plan, but clients might not always want that. They might just want, can you get me 500,000? So surely we should be able to offer advice on product implementation. Or a client might have an existing plan that they're quite happy with, but they're not happy with the price and just want you to check it against the market. So as you can see over those last 3 slides, that we're trying to say is, hey, I do more than just the product. Yep, the product's part of it, but let's work out what you actually need first. Other advice that then comes into that is obviously, and in fact, I don't know if any of you have read Gordon Watson, the founder of Fidelity Life. He wrote an excellent book. He was selling insurance, I think it was for National Mutual, but he realized as he was trying to deal with more business owners and people of higher wealth, that actually it wasn't so much about selling insurance, it was actually about helping them with estate planning. And he went and studied estate planning at university because he realized actually it was the estate planning that needed to be done first to then determine what funding is required for the estate to make sure that the outcomes are going to be done. So he expanded his advice from just insurance products to actually, well, let's put a plan in place. Funding came out of that, therefore insurance sales came. And it's the same with business insurance. With business insurance, if you're talking about shareholder protection and buy-sell agreements, well, there's a bit of work that needs to be done of putting the agreement in place to then determine if there's funding requirement. I have seen in the past insurance put in place for buy-sell agreements between shareholders, no agreement put in place, one of the shareholders dies, and actually we've created more of a mess now because there's money involved and no agreement to tie anybody into following through what the original intentions were. So if you're going to be involved in that space, then there's 2 things you can do. Can you give the advice around the agreements themselves or putting them in place? Or can you coordinate with the accountants, lawyers, and the directors to make sure the agreements are put in place and then provide the funding via insurance? Also, insurance on its own, it can be also included as part of a financial plan. So we have advisors who do full financial planning, and what they do is they project forward, lifetime cash values, and then they show clients where the risk is and determine whether or not insurance is needed and for what period of time. In fact, I had a client recently who was questioned as part of a FMA review of replacement business. He had a client where they'd replaced 200,000 trauma with 100,000 trauma, and the FMA said, well, why did you do that? Well, the advisor said, well, the client's 50 years old, and here's the cost of the use of money versus the guy paying off his mortgage. And they'd worked out, and the client was able to make a decision, well, you can keep 200, but if you only had 100, here's what the difference in premium will do to your mortgage over the 10-year or 15-year period that you'd have the cover. And it was a pretty simple, easy decision for the client to go, no, use of money, it was a much better option. So once again, the product wasn't the most important advice he was giving. It was, hey, whether you need the cover or not. Dealing with businesses, obviously, and self-employed people, we start talking about putting in place employee benefit schemes. Yes, there's some product advice in there, but the advice of really successful group sales is actually more around the employee benefit side of it and how that works out compared to, say, paying increases in salaries and wages. And then the value around ACC planning. The ACC planning, once again, it's less about I can sell you income protection, therefore you don't need ACC. It's more about saying, well, do you understand how your ACC levies work? Are you in the correct rate? And then do you understand the gap? And is it the best spend in line with the rest of your insurances? All of that advice is very valuable and isn't necessarily about the product itself. So mortgage advice, as I said, it could be, the proposition is I can give you advice on obtaining I could give you advice on obtaining a mortgage from a selection of lenders. And that's really good. So I can help you pick it. But what we tend to find is that it's more about determining what do you want? What's the question you're trying to answer for the client? So a client might come to you and go, actually, I need to know how much I can borrow. Can I afford to purchase a house? Then it's about maybe selecting the lender. But then they might want help. Well, hang on, I want to pay this off as quickly as possible. Or I want advice on structuring and refixing. Or they might have some other plans. I want to buy another property in 2 years. How can I set this up for that? In some cases, we're starting to see mortgage advisors even get into the point of actually assisting clients in making smart decisions about the type of property they buy, working out rental yields and things like that. Hi, David. Am I still? Hi, David. Can you hear me?
Can you hear me, Barry?
Yeah, I can now.
Yeah, cool. Okay. So
What happened there?
I don't know.
No idea. It just dropped out.
Yeah, sorry.
My apologies.
I think we're back.
I'm not sure.
I don't know why that was. Let's keep. Hopefully, we can keep going.
Okay. Okay. Sorry about that, guys. So once again, it's not just about the mortgage. It's actually about the advice around it. And staying with investment advice. Investment advice. Yep. I can do managed fund products. We can do KiwiSaver. We can do PI funds. We can do DIMS funds. But actually, firstly, let's set some, have you got objectives? Have you already worked out your financial goals? Or, so do you have future income requirements, i.e. retirement? Do you want to grow capital or wealth for specific reasons? Or are you saving for something in particular? So once again, this is more about the planning service than it is about just saying, I'll help you pick which product. The reason setting goals and objectives against any investment product, so if a client does come to you and say, I want to invest 100,000, I want to beat the bank, that's really cool. So what does that actually mean and look like? Because if you do then invest the money, what is it the client's going to measure you on success? If it's not about achieving a funding requirement or capital growth, then it's actually more about them potentially why is it they want that capital growth or why is it they want that future income. Therefore, if you're only doing the investment portion, they might be disappointed by the investment. But yeah, that's about the difference between the planning service and the advice. Obviously, investment implementation is, yep, they do want to invest 100,000, beat the bank rates, and then you want to look at a planning option in the future. There's nothing wrong with starting off that relationship that way. KiwiSaver is an interesting one too. Sometimes I see in scopes of service, the client would like retirement plan / KiwiSaver, and we see KiwiSaver implemented. That's fantastic. I'm sure KiwiSaver will form part of the future retirement plan, but if it's not actually a retirement plan, i.e. we haven't worked out the funding requirements for retirement, it isn't retirement planning. It is actually just putting KiwiSaver in place. Also, if you're doing class advice around KiwiSaver, so that would be in the RFA space and some AFAs, really that is just selling the product. It's making sure that they understand the product they're in and their fund they're in. But if you're offering class advice, as soon as a client says, is this going to be enough for retirement? Your advice stops there. You can't actually say, yes, it will be, or let's work it out, because you're then shifting into a planning service. So that's a bit more difficult one to add value to unless you're doing retirement planning for customers. Financial planning, one of the areas we see there is sometimes we see investment planning is called financial planning, but actually real financial planning is taken into account all of the areas. It's saying, well, let's look at your cash and debt management. Let's look at how we can protect the assets and wealth you already have, your income, for example. Let's look at how your estate and tax planning works, and are there investment strategies and products required? The key to financial planning, though, is saying, where are you today and where do you want to be tomorrow? Now, that's the objectives. If you can achieve the objectives, there's less focus on actually what the products do, but more focus on, does the client get there? And I had an example at the end of last year where a financial planner met up with a client where they did everything for them pretty much. And he asked the client, how do you think the year went for you financially? And she said, actually, I thought I went backwards a little bit. And he said, oh, why do you think that? And she said, oh, well, my current account usually had a balance of sort of between 12 and 15,000 each month. She says, I've noticed it's now sitting between sort of, 6 and 9,000. And he said, okay, well, let's take a look at what's happened in the last year. Over the last year, she'd taken an overseas holiday, she'd upgraded the car, she'd reduced debt, and her investments had grown. When they actually worked out the net position where it was from 12 months ago, she was actually $90,000 better off net wealth-wise, but obviously she couldn't see it. It was all each individual figure, but she couldn't see the clear picture. And that was the value that financial plan had provided, yet the client couldn't see it, which was a really good lesson. And that advisor's now changed the way he presents at reviews for his financial plans. And obviously, as part of the value of advice is really that meeting and reviewing the strategies. So even if you've had clients come in and start off as product implementation only, the reason you really want to catch up with them is to say, okay, cool, we implemented this KiwiSaver 3 or 4 years ago, but how about we sit down and work out what part of you it is? Yes, we put this insurance in place for you, but hey, what else is happening with you? Have you got the wills sorted? Have you got the estate planning sorted? Has your debt changed? Where are you going with this? How can I add value to help you achieve your goals? That's the most valuable part, I think, of financial advice. So if we think about those are the current different types of models that can be offered for financial advisors, what does the sort of future look like? And I guess one way to describe it, I think, is that your cheese is moving. Back in 1998, 2 books that I read, one was Who Moved My Cheese, and the other was The 21st Century Agent by Dan Sullivan. The other one was by Spencer Johnson. Now, these still remain relevant today in the fact that I think if we set in a particular advice model that was product-based, that we've been doing for the last, and we look forward to go, cool, will I be successful in the next 10 years? That's questionable because there are going to be changes. That's not to say you can't make an income and things will be okay for you individually, but if you were going to build a business on it that you wanted to grow and be profitable, it's going to be harder going into the future. So yeah, if you haven't read those books, it's worth a little look just to remind us of where we've come from. And these messages have been coming through for a long time now. So how do we implement a great advice proposition? And I guess the theme for this year is the things you can do that aren't all about the product, as we like to say. The future of advice is really around advisors who can help people manage their money. Now, interestingly enough, we're seeing a lot of noise in this space, especially on social media, from like the Commission of Financial Capability, from some of the bank institutions, and some other consumer-related advice, Sorted website, for example. So there's a lot of talk about it. There's a lot of information out there, but really there must be people who go, gee, this is all too hard. I know I want someone else to help me with it. And if we think about it, you know, all advice really is about cash flow. It's how much income you've got, how much you spend, how much can you save, or how much should you spend on insurance to make sure you've got someone something goes wrong. They're all interlinked. It was interesting when I was looking into some of the robo-advice platforms, I read this by Mark Zuckerberg about that the way forward is actually the best human and technology solutions together, producing easy, seamless, consistent, and emotionally engaging experiences for those we serve. And I think as we go forward, clients expect to be able to interact with advisors using technology. And so things that creates, I guess, opportunities for us. In some of the reviews, I've seen an Accenture study and also Salesforce research did a study in 2015. And it asked about 7,000 clients of financial advisors, you know, combined the two studies about what they want and, you know, what they're looking for. It really did show that communication needs are changing. People are busy. We used to send letters for renewal, and now some people send emails, and then there's phone calls, and some people do text reminders and all sorts. So how do you communicate with the clients? And it will be different for the type of clients and the types of advice. But, you know, have you asked your clients how they want to be communicated with? Their access to information is increasing. So if you're talking to a client and you suggest, and I saw an example of this a few years ago, an advisor did a bit of work with a business, put together a plan, ended up coming up with a recommendation around product. The accountant for the company then suddenly jumped online, or CFO, and found that Life Direct offered that product and did put the amounts in that the advisor requested. And there was the price ended up being a little bit cheaper, or it's because of the rebate. And he rang the advisor and said, thanks very much, that was excellent. We've got it all in place now, so well done. And of course, the advisor's left holding the baby. So if you think your value proposition is talking about the product and the product options, that's going to be available to them if they want to go and look for it. Obviously, some people won't. So personalization becomes important. So you might have some clients that want emails, some that want letters, some that want phone calls. So having a system and a process that's one size fits all might leave you out of the loop without it. So implementing how you do that, and remembering that advice is required potentially at different times. Not everyone wants to do a planning service up front. Some of them want to do it later on though, and being able to pick up when they're ready to do it. So I think the days of us being the experts, gathering all the data and presenting it back to clients and saying, here's what you should do. You should sign up with all these products and you'll be right, are probably gone. I think advice in the future is going to be more about consultation and educating clients so that they understand the decisions they're being asked to make. So here's, I guess, 3 ways to offer more than just product with that in mind going into the future. The first one's really important, and that is actually pick the right clients. You know, do you have a target market? The reason why this is good is because if you can figure out who you can help best, then ideal clients become easier to find. There's an example from a few years ago, which I saw at the Risk Store over in Australia, where an advisor narrowed his target market down to car dealers who had families. He enjoyed dealing with car dealers, and so he understood the business model that they ran and some of the risks they faced in their business. So he packaged his insurance advice around specifically their needs. They found that really good. The reason they had to have families, was in his mind, was, well, they either have to love their business or love their family, otherwise why would they insure it? In the end, he got paid to prospect. What that meant was that car dealers, the networks would actually fly him to speak to their dealer meetings around Australia. So he was getting paid to do that, and then after the meeting, half of them would ring him and say they want to be a client. So it is good to figure out, what is your niche? What are you good at doing? We've got some clients who now focus, solely on protecting key people and businesses. Some of them deal with another client who focuses on consultants who work on temporary contracts, and they become really good at that niche. And of course, they get referred to other people in that area because that's their specialty. So the key thing is, what are you good at doing? What part of the process do you like doing? We recommend looking to potentially outsource stuff that you're not good at. And that's going to be a key part of one of our sessions this week, is looking at, okay, well, how do I outsource and how do I make sure I retain control, and what does that look like? So for example, when the discretionary investment management service issue popped up a year or two ago, people were going, oh, I've got to get a DIMS license so I can balance portfolios. But it was interesting when we then sat with the advisor, go, well, how often do you actually do that? And they go, how often do you implement an investment solution for a client without getting them to sign off on a change? And they said, oh, maybe 2 or 3 times a year. And we said, well, actually, you don't need to be DIMS, because you can get someone else to do the rebalancing. You don't need to then require a license. So yeah, what are you good at? What do you enjoy doing? And what clients do you want to be dealing with is an important question to ask. Because once you're in a niche, then you can go, well, what's going to add value to these people? The key thing then is, once you've got the right clients, is giving them the right advice. As I said, I think consultation with clients going forward is going to be important. They might want a lot of advice. They might want a small part of advice, but that's going to be up to them to decide. So really, we're starting to look at the advice role, especially if you're going to get involved in the planning style service, is actually more of a coaching role. So I reckon, look to be the clients, was it a financial coach? Is it their insurance coach, their money coach, investment coach, whichever word you want to use. Remembering that all advice is cash management, really. Products will help you achieve the outcomes, but actually sometimes it's more about what they do with their money day to day, how it's structured, rather than just the financial products they have. So it's about saying, how can I show you a way to achieve the outcomes that you want and have the right products doing it? How do you show value? As I said with our financial planner example, one of the things that he's decided out of that was to give clients an actual dashboard each time he catches up with them. I know some advisors have TV screens in their offices where they put up either spreadsheets or charts to show how they're tracking, and it can be really powerful. A file I read towards the end of last year talked about clients that were negative 70,000 sort of net wealth, and after about 3 years they were plus 360,000. Now, I know the Auckland property market had a bit to do with that, but it was also the fact that they got their spending under control and they started saving as well. So, and managing their debt. So even with mortgage advisors, it could be really important, especially to catch up with them when you're looking at a refix, actually stop and say, well, hang on, let's redo your current position of where you're at. And if you can show that the mortgages you put in place or the repayment plans you put in place have put them ahead of where they thought they would be, or at least on track where they thought they would be, if they're behind and they weren't where they thought they would be, that gives you the opportunity to say, hey, do you want a better help me coaching you on ways to review your budgets or review your spending? That's going to be valuable, because people, if it's a one-shot transaction and then you go back for another product transaction and their financial position hasn't improved, then you've missed potentially an opportunity. So I think it's probably the best way that and the same with the insurance. You can actually say, well, yes, you've spent this much on insurance, but then show a graph of, well, you've had this much coverage. So had in the last year or in the year coming up, if you have one of these events, here's where you'll be, versus if you don't spend the money on insurance, here's what the bottom line looks like without it. Somehow we've got to show clients the value. Clients don't see it. They pay a premium. They see some numbers. I'm paying for a $65,000 a year income protection policy. If they're 30 years old, that could be worth, a couple of $1 million of cover they're actually paying for. Do we actually show them that? The other one will be technology will be the enabler. In last year's sessions, we ran through, so for those of you, if you haven't seen them, you can go back and have a look about implementing technology. In this session, we're going to be looking at actually how to implement services that are valuable, potentially things that you could charge for. So are you able to share information and data with clients, tracking results and showing value? Maybe provide a vault for important documents. Anything that links you with them and their financial, as their financial or money coach or their insurance coach, and that you can then potentially share with other experts. So for example, if you're not doing the estate planning as part of your insurance advice, well then how do you get involved with those that are doing the estate planning? Because if you're not involved with the estate planning and somebody else is, there's a good chance that your insurance plans are going to be questioned. So getting involved is important. And it's the same with mortgage brokers. If there are other people involved in making the decisions for the client about their future investments and things like that in property, you know, once again, that could put at risk your relationship if it's a product-only relationship. So keep up to date. Look, listen, learn. There is a real drive in the fintech area at the moment, so make sure you do keep abreast, and also check out you know, some of the things that are happening overseas, especially around that robo advice space, and the types of services that some of the overseas firms are actually offering, things like vaults or things like interactive where clients can go and do their own scenarios and bits and pieces. So it's about enabling the clients. It's almost like it's unlocking the Pandora's box or letting them behind the curtain. Let them, the more they understand, and the more they understand where they're going and why it's good for them and what value you've added with your advice, I think it's a good chance that you'll have a client for a long time. So the Financial Advisors Act review, where is it at? I think towards the end of last year, we covered off what we thought was happening or thought could be coming out based on the draft, and we were waiting for the draft bill to come out, and that obviously came out. So as it stands at the moment, we've got to the end of this month. There's a consultation paper. In fact, what they've decided to do, and probably about time in some cases, is actually merge the Financial Advisors Act as part of the Financial Markets Conduct Act, which is where all the other legislative products and services are sitting under already, which is quite good because we're actually, as financial service providers, you're caught by the Financial Markets Conduct Act already for Section 2. So putting them together makes sense. And in fact, some would have argued that the Financial Markets Conduct Act regulating the product providers should have come first before the Advisor Act, but it didn't happen that way. So if the bill gets passed, and I do say if because we're running into an election, and there is some talk about if it doesn't, will Labor pick it up if they get in, or will it continue? So we're still not 100% sure of when the bills are passed and then the regulations get written around that. But what that will require is for the code of conduct to be approved for all financial advisors caught under the new licensing regime. If that does come out early 2018 or late 2017, that bill's passed, they're aiming for August for that new code of conduct to be approved by the ministry. And then from February 2019, all existing RFAs, AFAs and QFEs will be transitioning to become fully licensed by 2021. Some people have said that's a long time. If you remember back though, the Financial Advisors Act was passed in 2008, but wasn't fully implemented until 2011. What it does mean is that there's no need to sort of rush out and do a whole lot of stuff today. The key thing would be giving feedback. There's still some debate around financial advice representatives. I don't like the term. I think anybody sitting under a product provider who isn't providing full financial advice or having it available for those types should actually be deemed maybe a financial product representative or a financial product distributor, something like that. Whereas firms who aren't part of product providers, then obviously financial advisor and financial advisor representative make more sense. So what does the draft bill do? As we guessed last year, we thought labelling would change, sales versus advice would come up, code requirements would change, disclosure would be standardized, and licensing would come in, and pretty much all of that has been mentioned. Though the key thing is, sales hasn't been defined as part of this. It just sits in there as that if somebody's a product provider, they can distribute and sell their product without giving advice. Whereas I actually think maybe the licensing should extend to say, we have a license to sell our products via staff members or nominated distributors who are salespeople, or we distribute our product via financial advice providers and they're licensed separately. That I think would just clarify to clients, consumers, to know when am I being sold something versus when am I being advised on something. And I think that's a key part that's missing. So with the labelling changes, AFA, RFA, QFE gone. Everybody who wants to be a financial advisor needs to work for a financial advice provider who's licensed with the FMA. And the license holder can either have financial advisors who are individually responsible or financial advice representatives where the license holder is fully responsible for their advice. And that makes a bit of sense when you think about some of the models whereby they have very strict systems and processes that the financial advisor has to follow, where he doesn't actually get to have his own opinion on the advice that's being given. In a similar way, that also allows for robo-advice, where the provider writes the algorithms and the systems, and therefore they're responsible for any advice that comes out of the robot. So it does make sense when you think about it that way, but as I said, I'm still concerned about how that fits in with product providers. Advice is advice. So category 1, category 2 will be gone, and also the financial product definition will be part of the Financial Markets Conduct Act. So all category 1, category 2 products will be thrown in as a financial product. So what that does, it doesn't mean that if you become a financial advisor, you have to be able to give advice on all products. You will still be able to define what advice services you provide. And this is where it's going to get interesting. For example, you might give advice on KiwiSaver implementation, but you might give full planning services for insurance. So the Code of Conduct has got a big job to sort of put a matrix together of how all the different codes of conduct under each product thing will fit together. So that's a big piece of work that we don't see until probably 2018. But the key thing for a message, I guess, out of that is going forward, think about what services, what clients you want to be dealing with, and then we'll be able to apply those to the licensing regime when they come in and give you the options. As I said, sales versus advice, this future regime really only talks about advice, not, it doesn't capture information or execution only services. So a firm could say we sell insurance products and we give no financial advice, therefore we don't have to hold a license to do that, I guess is what I'm saying. Competency standards, that's the big bit, and we will wait and see what they come up with. I think the working party is going to have a big job trying to figure that out, but we'll wait and see. There will be different standards across probably different products and different types of advice. I don't think level 5 will be the minimum standard for everybody. I think it will vary depending on the level of planning service you provide and the types of products that you provide still. But the good thing is you will be able to pick and choose as part of either your license or your firm's licensing. If you are doing level 5 though, as I said last year, continue on, it'll definitely be part of the mix. But if you haven't started it and you've got some experience and other bits, because workplace assessment has been mentioned as part of the draft. What that means is if you think you're working at the standards the code committee set, you'll be able to have a workplace assessment done rather than just going and doing a qualification. And if the assessment shows that yes, you've met certain unit standards, then they'll say, cool, that'll be acceptable for your license. Or you've met some of them, but you need to go away and do these ones. And that's what that transitional 2-year period, I think, will be. It'll be for people to say, right, I'm going to go for this license, and this is how I'm going to meet the competencies, and I'll have that done by 2021. AFAs, I think, as I said last year, we assumed they'd have a good transition, and it's been backed up in what's been said, and the fact that they'll take into account the most recent authorisation renewal as part of the licensing process for AFAs, whether they're doing that as part of a firm licence or individual licences. AFAs, obviously the competency standards will be set, so there will be some work to do there. The code obligations will apply to all advisors, remembering that the code of competence at the moment only applies to AFAs. So, and in fact, the main tenets of the current code of conduct have actually been put into the legislation, things like client first and conflicts of interest. So that will apply whether they're a big firm or an individual advisor, which is, I think, a good outcome. We don't know what the licensing requirements will be. There's been some talk about how that system and process works on good returns. Generally, there's a flat fee which allows a certain number of hours, whether it's 25 hours. Some of those bit larger firms have gone over that and had to pay more, which I think is fair. If you've got a small firm, then you shouldn't have to pay more than a firm with 100 advisors and many layers of management. But as I say, we're probably not starting that process till February 2019 at the earliest. And FSPR will still be there, so things will change a little bit. All providers will be on the FSPR. All financial advisors who give individual advice and are responsible for it under that license will be registered. Financial advice representatives, those, similar to now how QFE advisors aren't listed on there, they won't be listed on there. So no real changes there. Disclosure, once again, that's going to be regulated, and they're looking for the industry to come forward on that. I think anything will be better than the current RFA disclosure, which basically is just, here's 3 ways to complain about me, which is not a nice way to start a relationship. And yeah, as I said, financial advisor representatives, they were previously called agents under the previous draft. I still think that name's going to change, and there might be some movement on that. Apparently there's been a few meetings with some of the professional bodies and the ministry because of the furore that's out there. So the overall message is don't panic. Keep planning, keep driving where you want your businesses to go and the service model that you want to be providing clients, whether it's planning services or financial advice, and keep thinking about the future of where you want to go with that, so that when we come to consultation in 2018, then you'll be able to start making decisions of how you engage with this new process. So the future, we think good advice will really be coaching clients to achieving outcomes. This creates a great opportunity. It gives you the opportunity, and I think the licensing regime's a lot better because it doesn't just divide everything up by products and class and personal advice, etc. You'll be able to state the services you want to give and get licensed for those, which is a good place to be, because if you get a license, then you're on the right side of things. And the use of technology is going to become more important to enable a better experience for the clients and hopefully profitability for your business going forward. So thank you for your time, ladies and gentlemen. I'm happy to take any questions that pop up.
Excellent. Thank you, Barry. Hopefully you can hear me okay. I think I'm taking my mute. Cool. There was one question came up, so I came with a copy of the slides, which I've said yes to. There's some big themes today, really big themes today, and talking about the future of advice. Interesting, the 21st Century Advisor book you mentioned, because some of those themes that we're talking about today were noted, I think, in that book. And I guess from my perspective, anybody online, if you've got any questions, obviously feel free to throw them into the Q&A box. But I'll just raise a couple of things really. I think the issue of technology is continuing to play an important role in the industry, and probably in a more accelerated way. And it's providing opportunities for us, but it's also changing the landscape and will drive the need, I think, for some of the other themes that you talked about, going forward for all of our members, and that's around things like personalization. So, technology is going to enable commoditization of product, and it's really the advisors that are adding additional value around the service, around those products, that are really going to succeed, I think, going forward. I think the other thing as well is picking the right clients. It was a really useful point. Everybody talks these days about picking a niche and actually focusing on that niche. I think that with commoditization of product and what we're seeing with things like some of the things that the banks are doing, it's really going to be around identifying clients that are able to benefit from your service, rather than just going after everybody and identifying what those.
Well, it's interesting when it comes to when we see client complaints for advice businesses. When a lot of the time we talk to the advisors knew up front that the client was trouble and or was unsure about them, and they probably should have walked away, but they didn't. They had that. It's almost that approach. Well, they're a client, they want to buy, but if you don't like them, don't deal with them. We're not a public service, and there's actually more danger with it. We have had one client who, over the last 18 months, he's completely revamped his business, where before he dealt a lot in the mum and dad market and followed a referral type model. But then he got introduced to some people that were quite a good referral network, which were actually more friends that he hung out with, and he suddenly realised that it's quite a different market, and he could spend a bit more time with them, and they would generally work out as bigger premiums as well. But whereas in the past he might try and do a sale a day around mum and dad's, he's now doing 1 or 2 a week. And he's enjoying it more, and he's got more time to spend on adding value to the plan other than just the sale of the product. He's more relaxed, and in fact he's taken to the model so well, he's actually selling off a large chunk of his previous style clients, because it's actually given him time to focus on adding value to those that appreciate it. And it's been quite nice to watch. And he's done a rebrand with it as well. So right. It takes a bit of courage, but it can be done.
Yeah, as I say, I think that's where we can see the industry headed, particularly around when technology is going to, with the robo advice model, is going to start replacing the product advice that we.
Well, I look at it at the moment. I follow Sorted on Twitter and probably Facebook or something as well, and they're firing stuff out there. There's a new game they've put out about money, a new app. They're on TV. David Boyle's out there talking about KiwiSaver. So people are starting to get information almost given to them. That will make them ask questions. Should I do something? So we need, if they've clients sitting there with products you've implemented that's being talked about in the marketplace or in the politics or whatever, you want to make sure the clients aren't thinking about the product. They're thinking about, well, actually, I've got a plan, and the product is just a piece of that. Because, I think the more information that goes out there, and the more chance someone will just Google it. And we don't want Google being their advisor.
Yeah. As evidenced by your accounting example you mentioned. Conscious of time, there's a couple of minutes question. The review, the exposure draft that got just recently get released. Yes. There was one topic that got, I think the financial advisor representative of financial advice, or financial advisor definitions are there does seem to be a receptiveness on the part of MB to rethink that split. But there was one topic particularly, which I appreciate your thoughts on, Barry, and that is the client first issue.
Oh, yeah.
And there was some comment about how do you reconcile the client first obligation with the need also to make a profit in your business. And that was I think the way it was worded, I can't remember the specifics behind it, but I think the way it was worded was suggesting that you had to sacrifice your business in support of the client. Was the
way they worded the legislation, it basically said, there could be, you had to manage conflicts between you and the client, sort of thing. And then it expanded to and conflicts with any other person. Like the wording of it as legislative wording was really bad. It's been that the question's been like that since it was actually put into the first code of conduct. I remember Tim Williams from Chapman Tripp standing there with the code committee going, if you take client first to the nth degree, it means we should do everything for free. So this is where I think in the second iteration they brought in, it's that reasonableness test. It's that, yes, you're in business, yes, you need to get paid, but is the advice you're giving not because you will get paid? It is the advice you're giving is because it's the right advice for the client. And I guess the easiest way to sum that up is, and which is a hot topic with the FMA, is insurance replacement. And my classic example is always, a client has $500,000 of existing cover. You've determined they need $1 million of cover. At that point, there's potentially three options for the client. One is increase their existing cover by $500,000. The second option is leave the existing $500,000 where it is and take the new $500,000 and add it on to the new trauma or IP, health, or whatever you're putting in place. And the third option is cancel the existing 500 and put the $1 million and the other products together. Now, an advisor on commission who only works for commission, they get paid the most for the last option. So that's okay if we can demonstrate that that option was A, suitable for the client, or the best option, or that the client chose that option. And that's the bit they're looking for when they're doing the Section 25 thing. They're going into it and going, well, hang on, they were sitting there with that product provider, they're now over here. What was wrong with the product provider they were at? Why couldn't we just adjust the sum insured? And if an advisor's answer is, oh, that's because I couldn't be the servicing advisor, that's probably a conflict. You see, that's the bit we get to. And so what the client first is saying is, there's nothing wrong with giving the third option in the three examples I gave, but should just show why either it was the better option for the client or why the client chose that option. So you might have said, let's leave the $500,000, we'll put $500,000 over here in the IP. That works out okay for you, underwriting risks reduced, etc. And the client goes, no, I don't want I don't want to be dealing with two insurance companies. Cool. So the client's then making that decision. That's fine. Yeah.
Yeah, it's an interesting challenge, and I think you're absolutely right. It's really making sure that the outcome is consistent with the needs of the client, and is best advice for the client.
Well, this is the bit at the moment. The KiwiSaver class advice or sales and advice thing came out recently, and it talks about class advice, saying you can give class advice on KiwiSaver where you can provide a comparison between the existing KiwiSaver and the one that you represent. There's a couple of things there. The first thing is, well, why do you represent the one you're representing? Why did you choose that one out of the 8 or so that you could represent? That's the first question. Second question is, when you do provide a comparison, I bet 50% of the time the client's going to go, which one should I go with? Mm-hmm. At which point a class advisor can't answer that question, but they're conflicted if they don't. What they should say is, I can't answer that question. If you want to ask someone that, go ask someone else. But then, of course, the conflict is, I could lose a sale here. So going forward, that's where we're going to have clear processes. The good thing is the class advice thing disappears. So if you're going to offer advice on KiwiSaver, you'll be able to offer advice on KiwiSaver. Yeah,
subject to meeting competency standards. Yeah.
Correct, yeah. And I don't think the competency standards for that thing should be that high. It could be, provider training and research base might be enough with, rather than having to do full diplomas or something.
Yeah.
If you're not doing retirement planning, if you're just doing the KiwiSaver.
Yeah, it's an interesting one. Thank you, Barry. Hopefully you on the line today have found today's session to be of value. We've got another session coming up, I think, in the end of April, beginning of May. I can't remember the title, Barry, but keep an eye on your inbox. We will send you out a notification when it comes up. Barry, thank you once again for your time.
My pleasure.
If you're on, if you haven't yet, or if you want to submit to MB, there is still time to do so. It's due in, I think, on the 31st of March. We being NZFAA, will be putting a submission in on behalf of members, which we'll make available to members once we've drafted it up, hopefully next week. In the meantime, have a very good weekend, and we will see you online. Apologies for the minor technical issues we had partway through. We'll see you online at our next webinar in a couple of weeks' time. Thanks very much.
Thanks, David.
Cheers,
Cheers, guys.